All right, let's talk about the financial model exercise answers. We'll kick it off with the revenue tab. So right here, what goes under this box for all 4 quarters? Well, it's actually just an addition of revenue line item 1 and 2 from below. And in terms of what goes under this box here, well, it's just a percent total. So this is total revenue up here, right? Which is just that plus that. Well, it's just be this divided by that. That's the percent. Okay, cool. In terms of revenue line item 1 of 2 right here, well, looking at pattern recognition, this here would be 80%, right? Because we went from 110, 100, 90, 80. Okay, so right here, this would be 80%. All right, cool. And then here, we'll just follow the same pattern, 70, 60, 50, 40%. And then here, it's just 80% times revenue. And under here, again, just pattern recognition, this would be 80% as well. All right, let's go through the income statement now. So depreciation is 5% of sales across the board. Therefore, it's also going to be 5% right here. And in terms of what numbers go under this box for all 4 quarters, well, it's just revenue from the previous tab, right? And it's green, which means it links to another tab. Okay, it's just total revenue. Adds up revenue line item 1 and 2 from the previous tab. Okay, cool. So in terms of cost of goods sold percent of revenue, again, we look at pattern recognition, 30%, 28, 26. Well, these will be 26 for all 4 quarters as well. All right, and then sales and marketing goes from 16% of revenue to 15 to 14, right? So it's just going to be 14% times sales, right? And that will give you sales and marketing as a percent of revenue here. Okay. And then now we have product development as a percent of revenue. We go from 15 to 14% to 13. So under here is 13 as well. It's just pattern recognition. And then sales and marketing under here would just be 13% times revenue, right? And again, you can double click on any formula here or box here to find out what the formula is. Okay. Cool. All right, cost of goods sold as a percent of revenue, we go from 24 to 22 to 20. Therefore, here on a quarterly basis, it's also 20. And then 22, 20, 18, 16, 14, 12. Okay. Now, sales and marketing, what goes under this box here? Well, it's just 12% because we go 13, 12, and the quarterly numbers are the same in this example as the annual numbers. And then here we go 12, 11, again, it's 11% under here. And then depreciation is always 5%, okay? Same here. And then G&A here is just going to be 10%. Okay. And then sales and marketing here, it's increments of 1, so it goes 11, 10, 9, 8. Okay. And then with product development, again, pattern recognition, 12, 11, 10, 9, 8, 7. Okay. So margins are improving, and we're actually getting margin expansion here. And then G&A goes from 11 to 10, 9, 8, 7, 6. Right. Nice leverage kicking in. And then with other income, that's pretty small. So it's ones all the way across for a total of 4 for the year. And of course, the same thing here for the annual numbers in the future. Okay. And then for tax, we know it's 30% across the board, right? And then what goes under this one here is just 30% times pre-tax income. And then here, 30% across the board, and same with this one here. Okay, and then for the share count, you'll notice it hasn't changed at all, right? So it's still 1165 for every single quarter and year. That's it. I think we covered everything here, did we? Yeah, we're good. All right, moving on. And remember, don't touch this one. All right, moving on to the balance sheet. Total current assets is simply an addition of all these non-percent items here. And CapEx is 10% of revenue here, right? So we just multiply it by 10 on the previous tab, okay? And here, CapEx is always 10% of revenue in our example. Accounts receivable is always 5% across the board, okay? And we can actually do the same thing here. Same for here, 5% across the board. And then accounts receivable is just 5% times sales, right? And then inventory is always 11% of sales. So we can even get rid of this one here and this one. It's just 11% across the board. And in terms of cash, well, the difference between this year and this year's cash is quite simply cash here plus the cash addition from the cash flow statement, okay? Remember, the cash flow statement always explains the difference in cash between one year and the next. And if you're confused, you can always just double click here and it'll take you directly to the appropriate cash flow statement field, okay? Now, in terms of equipment, CapEx as a percent of revenue is always 10%. That one's pretty easy. And then depreciation, we got it from the income statement, remember? So that would just get pulled over directly, and it's green because it's from another tab. And then the calculation for equipment we own net of accumulated depreciation and inclusive of CapEx is quite simply this. You take last year's equipment, okay, net of all depreciation items, okay? And then what you do is you deduct depreciation from this year and then add back CapEx from this year, okay? And accounts payable as a percent of revenue is always 3%, right? It's just pattern recognition here. And CapEx, when it comes to depreciation, you're just linking directly to the income statement here. All right, getting there. See if I forgot any ones here. No, we're good. Cool. All right, long-term debt here is just 5 across the board in this example. And then shareholders' equity is just retained earnings plus common shares. And to calculate retained earnings, you just basically look for the difference in net income year over year. So you take the most recent quarter or year's retained earnings, and then you add net income, okay? And again, if you're confused with this, just double click and go to the other tab and understand the logic that way. Cool. Long-term debt here is 5. And retained earnings here, again, it's just last period's retained earning plus net income from the income statement tab. And one more over here. Okay. Total liabilities and shareholders' equity, it's quite simply an addition of total liabilities and shareholders' equity, right? So it's that plus that. All right, we are done with the balance sheet. Let's move on to the cash flow statement. This is actually easier than you think because it's just numbers that are automatically linked to the income statement and then the balance sheet. And in terms of depreciation, you pull it directly off of the income statement, okay? Let me just get rid of this. All right, now in terms of accounts receivable, looks like accounts receivable actually went down. And that's a good thing cash-wise because we now have a little bit more cash in our pocket. Same thing with inventory. And in terms of accounts payable, the inverse logic is true. Now, purchases of equipment, you just link directly to CapEx from the previous tab. And if you're ever confused, what you can do is you hold Command on a Mac and square brackets. See? And it goes directly here to CapEx, okay? It links directly. It's a cool little trick. All right. Now, cash at beginning of period and cash ending of period, you just take beginning period plus the increase or decrease in cash. And I'll show you what that means here. Okay. And then you link directly to the cash flow statement. So this here is the cash balance from the cash flow statement, okay, all the way across, right? And this is cash from last balance sheet and cash from current balance sheet, okay? And then here, this is just a cool little calculation to test to see if these two are equal. All right. And in terms of net increase or decrease in cash, it's just cash flow from operations plus cash flow from investing plus cash flow from financing. And then here, similar logic to what we talked about here on the quarterly basis, but on the annual basis, you just take depreciation on an annual basis directly from the income statement. Increase in receivables, same logic. You get it directly from the balance sheet. And if it goes up, then it hurts our cash. It's negative, okay? And then increase in accounts payable. It's actually the opposite logic. Remember that. So If we owe more money, then we have more temporary cash in our pocket. And that's a wrap.